After threatening more tariffs, President Trump signals an openness to dealing with China, offering President Xi a possible ramp-off. But Beijing's drawing clear red lines on U.S. export controls, making it hard to quickly ease trade war risks. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Goldman Sachs sees the latest U.S.-China flare-up as a tactical move ahead at the APEC summit, but warns of a wider range of outcomes from tariff cuts to fresh export curbs. We'll discuss this with Henrietta Levin, a former White House and State Department China advisor, and for the market's perspective, VS Partners Hong Kong co-founder and CIO Vanessa Xu will be sharing us her take. And of course, we hear exclusively from Malaysia's second finance minister on why he believes the government's moves to cushion the blow from Trump's tariffs could further boost the ringgit. And we have breaking news for China's trade for September. Of course, data that's been widely anticipated. We have China's September exports in USD terms rising more than anticipated, up 8.3% year on year, beating estimates of 6.6%. That is a massive jump in imports as well. Take a look where we are in terms of those import numbers. We have imports coming in USD terms rising 7.4% year on year. The estimate was for 1.8%. So both in terms of imports and exports, a beat. Imports suggesting perhaps there is a greater appetite in terms of demand. Imports again in USD terms rising 7.4% year on year. The estimate was for 1.8%. In terms of the trade surplus, we're looking at $875 billion. That is USD for the period of January to September. So across the board, pretty much a better than expected figure, suggesting that perhaps we're seeing resilience in the Chinese economy. Now, in terms of the market, here's a look at how markets across Asia are digesting the latest escalation in U.S.-China trade tensions. Asian markets sliding, led by declines in China and Hong Kong, while Trump shocked investors with his new threat of 100% tariffs on China has also left a window open for a deal given his November 1st deadline. Optimism there already showing with gains in S&P futures as well as crude. Now, these numbers coming as President Trump says tariffs for China are still the plan for November 1st. But speaking on board Air Force One today, he called Chinese President Xi Jinping a smart man and a great leader. Trump also highlighting that he has given himself plenty of time to work out a deal with Xi before his deadline.
For me, you know what November 1st is? An eternity. November 1st is an eternity for me. For somebody else, it's right around the corner. For me, when I hear November 1st, it's an eternity.
Let's get more on the U.S.-China trade tensions with Henrietta Levin, Senior Fellow at the Center for Strategic and International Studies. She previously held senior roles at the U.S. Department of State and the White House. Also with us is in Hong Kong, John Liu, Senior Executive Editor for Greater China at Bloomberg News. John, first of all, set the scene for us. How are you looking at this tit for tat?
Well, everything kicked off late last week when China announced these very broad measures to increase controls over the export of rare earths, these critical minerals, essentially giving China the ability to exert influence over any product if it uses even the smallest amount of these rare earths. And that, in turn, kicked off this response from President Trump on Friday during the U.S. Day, where he threatened and then did actually impose a 100% additional tariff on Chinese goods. What has been really interesting, though, I think, is the 100% tariff that President Trump has imposed. That starts on November 1st, as we heard President Trump talking about, an eternity from now. But also those rare earth measures, those are slated to start after that. So before the November 10th deadline for when the previous agreements between the United States and China are set to roll over. And so it does really set up a scene where the two presidents, Trump and Xi, are set to meet, we expect, at APEC at the end of October. So that really puts the onus, or it really ratchets up the anticipation of what we will get out of that meeting.
So, Henrietta, is it about the timing? I mean, this is coming on the cusp of the two leaders set to meet on the sidelines of APEC.
The timing does speak quite loudly. I think it is. We're seeing both sides realize that they may have overplayed their hand in introducing more escalation into the U.S.-China relationship than either side was seeking. Donald Trump has announced, as you mentioned, that he intends to impose 100% tariffs on China as of November 1st, but the timing is important. That is intended to be right after the leaders meet at APEC, and Trump has spoken quite warmly just today about his interest in maintaining that meeting with President Xi. So you have to expect that he's setting this up more as an opportunity to save the day and bring the U.S.-China relationship back onto an even footing than to go back to what was an effective trade embargo that the U.S. demonstrated it could not withstand, especially when we consider the prospective retaliation from the Chinese side in leveraging its choke points on rare earth minerals. The U.S. has showed it cannot withstand what President Trump is promising to do. And so I think this is more of a negotiating tactic than a policy plan.
But Henrietta, how would you describe relations between the two sides now? Are they better? I mean, we know that we've had 4 high-level meetings over the past perhaps 5 months between Scott Bessent and He Lifeng. That was to stabilize relations. Where are we with that?
Look, I think it is always important for the leaders of the United States and China and for their lieutenants to be talking, to have an open dialogue, to ensure that any misunderstandings can be addressed before we end up in the kind of unintended escalation spirals like we saw over the past day or two. But it does also seem like in these talks, there is not always agreement between the two sides of what is even being discussed, let alone agreed. And so these conversations have also, in a way, proven a opportunity for destabilization in the relationship because there isn't always agreement on what is even on the agenda. I would also say it does seem like the talks have been mired really in managing of the tit-for-tat retaliation the two sides have brought to bear, rather than addressing the underlying economic structural concerns that Trump's trade war was ostensibly intended to address.
And John, what's China's perspective here? We know that Trump was quite quick to dial down the tension, saying everything is going to be okay with China, that perhaps Xi Jinping had a bad moment. How is this landing in China?
Well, I think if you asked the officialdom in Beijing, they would say they were forced to take these steps when it came to rare earths, when it's come to these additional fees that China is imposing on American shipping now. They would try and say that they had to do these to draw a red line, to show that the United States, after the talks in London, after the talks in Madrid, the agreements reached in those places, the United States did take actions to broaden, for example, at the end of September, how the Commerce Department enforces the entity list that it has, starting to impose those restrictions on the subsidiaries of companies who are on the entity list. And China would argue that those steps showed that China had to take a tough measure to show the U.S. could not continue to sort of chip away at whatever agreements the two sides reached in these meetings that they've had on and off for the last few months.
And China coming from a position of strength, you would imagine. I mean, you do sense the confidence. It has said repeatedly it is not afraid of a trade war. It said it again over the weekend. So I guess its dominance over the supply chain of rare earths is really giving it that confidence. Is that a fair assessment?
I think Beijing's feeling fairly confident at the moment. You were talking about the trade numbers that are just out at the start of the show. Trade is doing well. I mean, Chinese exports to the U.S. are down, but they're going up to everywhere else in the world. And so that, I think, offers a measure of reassurance to Beijing that it can take the pain for longer than Washington can. But I think at the same time, China's economy is, I would say, in a fragile recovery at best. And so I don't think the Chinese, in the best situation, they would not like to see 100% or 200% tariffs on their goods. They'd like to get this thing resolved.
And Henrietta, the U.S. economy also at risk right now. We're looking at a government shutdown, and we're yet to see the full impact of tariffs on the consumers. So Trump has to take that into consideration, too.
I think so. And, looking at the perspective from Beijing, they are betting that they do have the upper hand in any trade war with the United States. They do have, I think, an incredible amount of confidence in their ability to manage the U.S.-China relationship and Donald Trump, because they think that they will take economic pain. Their economy is not doing very well from economic punitive measures from the United States, but they are betting that the U.S. economy will hurt worse and faster, and that the U.S. political system, the U.S. society cannot withstand that pain. And I think they feel they've been proven right in that Donald Trump has backed down several times now from a more aggressive economic posture vis-a-vis China, and we've seen that again even in the past 2 days with him pivoting from a very aggressive message promising 100% tariffs to more of a conciliatory message towards Xi, enthusiasm for a meeting, enthusiasm for working this out. And I think that is because the economic picture in the U.S. is on Donald Trump's mind.
So a lot of room for de-escalation. That meeting on the sidelines of the APEC summit will come through, right? Because the optics are important for the world.
I think so. Donald Trump has made clear for months that he really wants to get in the room with Xi. He wants to have this conversation face to face. And the Chinese, for their part, have put out statements just in the past few days calling for dialogue and engagement and the implementation of what they call the consensus reached between Trump and Xi on their earlier call. So I think on both sides, you see a significant appetite for continued diplomacy and dialogue.
And John, if it doesn't happen, the fallout could be massive. Could it have impact on, for example, the TikTok US deal?
I think the reason that U.S. markets responded the way they did to those Truth Social posts from President Trump on Friday was because now the realm of possibility, the range of possibilities that we could get from this meeting between the two presidents at APEC has expanded dramatically. We could get some agreement that is much better than the markets had expected, but we could also get some escalation that is far worse than people had feared. And so I think people are, at the moment, really not sure what to think heading into this big meeting.
And John, some have suggested perhaps China offered a huge investment package. What do we know about what's on the table and how far and how much China is willing to give?
Well, I think we know that China has offered to invest in the U.S. That has been something that President Trump has welcomed from Japanese, European companies from around the world. We also know that China has pushed for the U.S. to change the way it describes how its relationship with Taiwan, to get the U.S. to say it opposes Taiwan independence instead of saying it does not support Taiwanese independence. That would be a big diplomatic political win for Beijing. And in response, we know that President Trump has talked about soybean purchases, for example. President Trump has obviously talked about rare earth minerals. And so I think these are some of the things that potentially are on the table.
And Henrietta, of course, we heard from J.D. Vance saying that China should choose the path of reason. What is that path for the U.S.?
I think that the U.S. is focused on securing tactical concessions from China, while Beijing is more focused on the strategic picture. So U.S. is focused on getting purchase commitments, for example, related to soybeans, agricultural products, potentially Boeing aircraft, that would be seen as political concessions to President Trump. Whereas you see China focused on getting from the U.S. side concessions on restrictions related to very high-end U.S. technology, including semiconductor technology for use in AI development, focus on the Taiwan issues mentioned earlier. And so you worry about a bit of a disconnect in the conversation where the U.S. is for the first time in decades, potentially willing to link these very significant strategic concessions related to American leadership and presence in the world to more tactical economic concessions that would bolster the president's near-term political position.
Great perspective there. Henrietta Levin, Senior Fellow at CSIS, and Joel New, Senior Executive Editor at Bloomberg News. We thank you so much for your time today. Now, still ahead on Insight, we talk investment strategy with VS Partners co-founder and CIO Vanessa Xu. More on the key themes she's seeing in markets. Keep it here with us. This is Bloomberg. Welcome back to Insight. U.S. equity index futures are climbing after President Trump signaled an openness to a deal with China. However, Chinese stocks are sliding, showing investors are still concerned about trade tensions. Let's get insights from Vanessa Xu, co-founder and CIO of VS Partners in Hong Kong. Vanessa, good to have you with us. What do you make of the reaction of the market so far? Seems pretty muted.
Well, the Asian market have responded in a measured way, particularly in China. Actually, domestically, some of the indices stood resiliently. I think on the narratives of retaliations on both sides over the weekend, it's a posturing ahead of important international and domestic events. In China, the party's plenary is set to happen at the later part of the month, and the APEC is set to happen end of the month. Both sides have very important domestic issues to address. On the U.S. side, the government shutdown, the Treasury, and the Fed policies, and several domestic issues, and China as well to continue to support the economy. So this is strong-handed posturing, yet embedded with the messaging that both sides, under certain conditions, are willing to talk, is a understandable stance ahead of the potential talks. I'm still holding the base view that the talk will happen, and behind the scenes, both sides will have to, like it or not, have to work with each other.
What happened over the weekend underscored the fragility of relations and the expectations of a long-drawn negotiation process. How should investors position for that?
Yeah, drawing the parallel of April, a very fast, sharp escalation of the narratives, then followed by both sides giving each other the, off ramp to focus on the very important reality. I think regardless of narrative, the both presidents are still bound by the economic reality, which is that China needs to boost its domestic consumption, needs to extend the credit, needs to continue to support by ample liquidity in order to reboot its economy. And the U.S. side, politically, it cannot afford a recessionary outlook, despite slight modest weakening in the labor market. So I think the market needs to focus on the fundamentals of economies. Actually, the U.S. economy is fairly resilient, but the risk is in the financial conditions, given where all the risk assets are quite pricey right now. And Fed is the administration is shifting the policy from monetary quantitative easing to a fiscal quantitative easing, i.e., through Treasury, not through the financial systems. So that actually will tighten the financial the condition, which is happening right now. So that is a actual risk in the near future to watch.
Do you see a buying opportunity? If you take a look at HS Tech, it's currently down about 3%. If you believe in the AI story, the tech story, the China tech story, then perhaps you should be buying up when everybody's selling.
There are buying opportunities, but it is more nuanced than just directly buying the tech and AI themes. And the big tech Chinese companies' earnings actually just revised down, not revised up, despite the very strong price performance this year. Because of companies have not yet found a valid way of monetization of the AI spending. In the US, similarly, we are actually looking at real asset investment, as I mentioned before, fiscal easing that goes into capex. The money, the system has the money, but the money has to go somewhere. Instead of the financial market, it goes to the real the Main Street rather than Wall Street. So the shovels that are providing infrastructures and enabling technologies to the taxi is a buying opportunity, but not it goes into power, goes into utility, and it goes into infrastructure rather than the tech company themselves.
How about consumption? I'm wondering if perhaps it is time to rotate to those consumption plays, given China's appetite to boost consumption in the country.
Policies have the headline policies. If you're talking about China, consumption continues to be soft. I think real PPI and CPI continues to be evidently from data that deflationary, stronger policy support still are needed. Therefore, this is a reality that drives the government to, be very pragmatic about trade negotiations because China do need a friendlier, benign environment with the global market, not just the US, but the rest of the world. But speaking of consumption, we do see very strong growth in large Asia economies, and particularly domestically. I just finished my research trip in Vietnam and in India, and despite the tariff headline that also hit these countries in over summer, but the domestic consumptions with very favorable demographics and credit expansion are growing strongly. So if we are looking for consumption growth, we are looking at Asia economies that are large enough to support a domestic market.
Before we let you go, we have to touch on gold. It rallied. It saw a little bit of correction. Where do you see gold headed, and what are you reading into gold prices right now?
Well, there are two things. One is the fundamental but slow change of a global currency system that moved to decentralized, currency or more diversified currency system. So, and another theme is about institutional investors are buying real assets. Gold is a very direct expression, and the gold stocks and the miners are direct expression of real assets, and previously was driven by central banks buying. So these thematics together support strong fundamentals of gold. But not only that, but the liquidity flow into real assets, and it's a late cycle effect of liquidity also flowing to commodities and the materials.
Right. Vanessa, great stuff. Thank you so much. Vanessa Xu, co-founder and CIO of VS Partners Hong Kong. Coming up, hear why Malaysia's government expects the ringgit to extend its recent gains. Our exclusive with the second finance minister, Amir Hamzah Azizan, is next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Let's do a check on Malaysian assets right now, ringgit in particular, which has had quite a good run, among the best performers in the Southeast Asian region, currently at 422. In terms of the KLCI, it's down with the rest of the region, currently down 0.4%. Of course, it's had a strong IPO market. Now, Malaysia's second minister of finance is expecting the ringgit to extend its recent gains. Amir Hamzah Azizan told us exclusively the currency could strengthen to just below 4 to the dollar, its highest since 2018. The ringgit has already appreciated nearly 6% this year, making it the best performer in Southeast Asia. Amir told us the resilience of the currency reflects the economy's solid fundamentals.
I think we've had a good first half. First half came in at 4.4%. And we've seen the exports are still holding and the development expenditure that's been spending it actually helping to support it. And I think one of the pleasing elements of it is private consumption has gone up because effectively the government has been trying to lift wages in the country. So we did minimum wage lift in February this year and the civil service pay increases, and they have been spending and stimulating the economy. So I think those are good support that's actually coming into the economy also on top of the normal exports and so on.
So 4.8 is a possibility.
Well, let's see. Despite all
Don't be shy, Minister.
Despite all the challenges we've all seen in terms of tariff and so on, I think the economy has got the resilience it's managing through. And I think we will probably end up within the range that we've declared.
Okay, that's not saying too much. For 2026, 4 to 4.5% projection. What's the biggest risk to that estimate?
I think when you look at it, I think we all adjusted the estimates down and we anticipated the effects of the rattling of the global economy with the tariffs and realignment of how supply chains are moving, how trade is actually moving. So a lower projection was expected. But the key for us in the Malaysian economy is to understand what can we do to the Malaysian economy, what can we stimulate in the Malaysian economy to keep it up. So I think if you look at what we've done in the budget, there was a lot of spends that were actually put in terms of supporting infrastructure growth, putting in long-term growth elements in terms of building the right type of infrastructure that the country needs in the future, and also making sure that our engines of growth, because export engines, FDI is still strong, but also making sure our SMEs are also looked at. So there were a couple of measures that we put in to actually make sure that the SME's engines continues to tick. So if we've managed to do that well, I think we are going to manage within that range.
Tariffs are a big uncertainty. You saw how, President Trump is imposing additional 100% tariffs on China, taking it to 130%. This is your largest trading partner, contributing to about 17% of overall trade. And some say 130% tariffs would mean stagflation, supply chain disruptions. How might that impact the Malaysian economy?
I think we've seen what's transpiring with the changing tariffs in the first half of the year. When we started the journey earlier, the signals were tariff is going to come in, it's going to rattle the markets quite dramatically. Countries will have to do dramatic shifts in order to manage it. But over time, practicality started to come in because it's a very much more integrated supply chain that we're having on a global scale. So I think this recent shifts will probably also find a better landing in the not too distant future, and we'll come back to what is probably a practical solution. And I think both sides are figuring that one out. So from a Malaysian point of view, the key is to actually understand what is the components of our trade. And our trade are E&E and semiconductors, but we also have still the commodities and so on anchoring the trade. So if we continue to do those well, semiconductors, which is a very narrow supply chain, continues to tick on a better note, I think we'll be able to ride it out.
Let's talk about the Malaysian ringgit. Pretty resilient. Is that a reflection of the fundamentals of the economy?
I think it is. If you look at it, we are first half year 190 billion of FDIs coming in and approved investments. We're seeing domestic investments also flowing well. We've seen, if I use as a proxy, and I look back at EPF as a proxy of formal employment, EPF's contribution rates have gone up. It's growing at 9% compared to the previous year. So that's a sign that employment is still good. My money is still being pumped into the system. And the interventions that we're doing to lift the flow so that the citizenry has money in its hands are also helping drive private consumption. So I think those elements have actually created resilience in the Malaysian economy. And therefore, people look at Malaysia in a slightly different form. And then with the slowing down of the growth of interest rates in other countries, particularly the US where they have been cutting, that's allowed the differential to get smaller. So the ringgit has equally strengthened.
Do you expect the inflows to pick up speed and further boost the currency in the next 12, 24 months?
I think it was important for us to make sure that 2026 is a year that we have enough built in to sustain the domestic economy. So I think that resilience will actually show value to investors going outside. The government fiscal reform is showing value to it. So we started off with a fiscal deficit to GDP of 6.4%. This year will end up at 3.8, next year will down at 3.5. So there is resolve. And if you see at all the reforms that we've been doing, it's about putting in fiscal discipline is coming in. And those are good signs to investors that are coming in. We've had a stable government, clarity of policy, and that's helped to attract investments.
So supporting the currency, the thing is, the ringgit's performance is also contingent on the dollar, which also depends on what the Fed does. Right now, expectations are perhaps for 2 cuts, but that may not happen. How do you see that playing out into your currency?
Well, even if you look at this year, there were expectations of further cuts, and further cuts didn't come in, right? But the ringgit still resilient, because the fundamentals are still strong, and the differentials have remained quite reasonable along that line. So I think even if the Fed slows down its process, the ringgit still has a lot of wind behind it to be able to push ahead along the way.
You talk a lot about putting money into the hands of the people. You did that with this budget. In fact, some say 60% of the budget actually goes into civil servant salaries, pension funds as well. Could you be missing the opportunity to perhaps carry out structural reforms which could then help the economy as a whole and growth?
I think this government has actually started to do a lot of structural reform, right? And one of the key things that we've been trying to do is to dial back on subsidies. And when we give subsidies, we're making sure that the subsidies actually end up on the right end of the stick. The challenge that we've had in the past was a blanket mechanism in terms of subsidies. When we did electricity, we targeted that industries and the top end of society will have to pay more, and the bottom end get some support along the way. And we've reached the point that subsidies and electricity have squared at this point of time. So the government is not putting any new money inside that. We've done that for diesel. From diesel last year when we rolled it out, with a lot of trepidation from a lot of people in terms of rattling the economy. But you've seen inflation under control. You've seen us also to still support the core segments of society, the logistics sector, so we are able to contain inflation, yet we're able to get savings. And now recently we've done that with petrol. So again, I think reform comes in many ways. And what the key things you have to do is plan it well, anchor it well, and make sure it sustains. And that's what we've been able to do in the journey that we have.
And that was Malaysia's second finance minister, Amir Hamzah Azizan, speaking exclusively to us in Kuala Lumpur. Well, for more on the resilience of the Malaysian ringgit, let's bring in Bloomberg Emerging Markets macro strategist Marcus Wong. And Marcus, of course, quite a turnaround for the Malaysian story and for the ringgit story. We started the year looking at a pretty lackluster currency, but here we are. It's among the strongest currencies in Southeast Asia.
Yeah, it is quite a turnaround, as you said, and owing back to what Amir said in his conversation just now, as well as the budget that we saw on Friday, investors love predictability. Investors love fiscal consolidation. The 3.5 budget deficit target for next year was actually even lower than what economists surveyed by Bloomberg were expecting, which was at 3.55% deficit. And this predictability is, I would say, juxtaposed against what we've seen with its neighboring peer, Indonesia, recently. I mean, at the start of this year, I think you could say that the cards were flipped. Indonesia looked like it was, going on this, solid fiscal trajectory. But, as we've seen, since September, with the new finance minister, that took over Mulyani, the fiscal guardrails that have anchored Indonesia for the past few years are now in question, now in doubt. And again, juxtaposed with that in Malaysia, this fiscal consolidation is quite positive for investors. And it's important to that point is because the government was expecting Petronas oil revenue to actually deplete next year. So the cut in subsidies comes in and very, very important at this point in time. And on that point, the government has some credibility too, because we saw the government expanding its sales and service tax base in June, as well as the rationalization of the fuel and the Euro 95 fuel in September. So it shows that there's some credibility involved, and investors are keen on it.
Juxtaposition. Interesting, you called out Indonesia, but it's not just Indonesia. It's Thailand, it's the Philippines. So it does look like Malaysia is the most stable market. Talk about stability in Malaysia, which is uncanny, really. So the prospects for FDI in the future is also playing into the strength of the currency, correct? Because that is expected to persist.
Yes, as FDI is all about investor confidence in the region, and sad to say, not sad to say, but at the end of the day, it's juxtaposition. So Malaysia is doing well. Its neighbours probably have some catch up to do, from what we've seen over the past few months. So the flows that Amir has mentioned, this could definitely extend moving forward. Definitely supportive of the ringgit, but not just FDI flows. I mean, other things that are supportive of the ringgit include the fact that Bank Negara is expected to keep rates on hold for the foreseeable future. Economists expect it for it to hold through 2026. In comparison, we've seen central banks such as Indonesia, the Philippines have surprised with rate cuts instead. So a lot of factors are supporting the ringgit, FDI, rate cuts. How, of course, US-China trade relations evolve from here is important. As rightly put, US and China are Malaysia's two biggest export partners. So their relationship will matter moving forward.
How about the rest of the Asian world? Because we're seeing today the Asian AFEX index falling to the lowest since May. I mean, that's trepidation. That's investors on edge, isn't it?
Yes. So, of course, the broad dollar has been part of the story, and that, of course, is related to how the euro and the yen has been performing. But, of course, to this region, a lot of it depends on how China and the yuan moves going forward. We've seen the yuan actually strengthen today, as the PBOC, of course, has signaled that they want yuan stability. So in the sense that, we can expect Asian currencies, even though you would say it's near a 5-month low, no one expects a sell-off from here. But of course, if the dollar continues to move stronger, and trade relations between US and China deteriorate from here, and that's a fair assumption, maybe in the near term, but who knows in the longer term, we could actually see Asian currencies, more further pressure from here.
And that yuan stability will also help prop up emerging market currencies in this part of the world.
Yes, definitely. A lot of
that correlation has become stronger.
Yes, you're right to say that, and a lot of it is due to the fact that the yuan is viewed as a regional anchor. A lot of two main factors. For a lot of is the main trading partner, or the biggest main trading partner for people in this region, and also the fact that it has a significant weightage in the currency baskets of, for example, like a Singapore dollar. So what happens for the yuan really does matter for Asian currencies.
So what are some of the themes that we're looking out for in the Asian AFEX space in the next 6-12 months?
So of course, you could say that we've been quite of a lull in the past maybe 3 or 4 months. US-China trade optimism has bowed. There were talks of meet between Trump and Xi. There were meetings between the working partners. So that has kept Asian currencies in a sense in a more buoyant mood over the past few months. So of course, this is now in question moving forward. How that evolves will matter a lot for currencies. Of course, how the Fed, will they one day? As you said, 2 rate cuts are priced in for this year. If that happens, that will be, of course, supportive. But I guess importantly for investors recently is there are a lot of idiosyncratic risk. We've seen with Philippines and the corruption issue that has really dragged on the peso. Of course, with rupiah, as I mentioned earlier, and also with Thailand, the stability of the new government. That there will be a vote moving forward, and it will be a question for investors out there whether the current administration will hold. So larger risk, of course, will be trade, but increasingly we're seeing that this idiosyncratic risk popping up in Southeast Asia. Safe to say Malaysia seems in a better position than most.
Yeah, and we see the reversal of fortune so quickly. Marcus, thank you so much for that. Bloomberg Emerging Markets macro strategist Marcus Wong with his assessment. Now let's take a look at how Chinese stocks are doing. Of course, China is at lunch break, but this is how it's looking in terms of the HSI. It is under pressure. Not surprisingly, the Hang Seng down more than 3% on the back of the tit-for-tat that we saw over the weekend between Trump and Xi Jinping. That concerns about those trade wars resurging. Also, we're seeing in terms of HS Tech down by 4% right now. Of course, this is one index which has been surging. It's climbed 31% in 2025 alone as Chinese equities benefited from a trade truce with the U.S. in addition to optimism over the country's growing heft in AI, of course. Taking a look at the tech giants, they're also under pressure, not surprisingly, but remember that the likes of Alibaba have surged about 100%, with Tencent up almost 60%. So those the drop that we're seeing today isn't really moving the needle. Still, Alibaba down almost 5% as we speak. Take a look at the Indian markets as we count down to the Indian Open. Let's take a look at the early numbers. Where we are in terms of how it is shaping up. This is a market that's been pretty much propped up by retail investors providing that support that we've seen so far this year. In terms of the Indian rupee trading at 88.74, Indian markets are also under pressure. The Sensex down by 0.3%. Sentiment being guided with the rest of the region in terms of those trade concerns from investors. Now, here's some more top geopolitical stories we are following. President Trump has reiterated that the war in Gaza is over and that the truce will hold. He's traveling to Israel and is scheduled to address Parliament later on Monday. If the deal holds, it would represent a major step toward lasting peace, something neither Trump nor his predecessor Joe Biden was able to secure in previous rounds of negotiations.
Okay, do you understand that? I think people are a lot of reasons why it's going to hold, but I think people are tired of it. It's been centuries. Okay, not just recent. It's been centuries. I think people are tired of it. Yeah, the ceasefire is going to hold.
French President Emmanuel Macron has announced a new cabinet as pressure mounts for the government to pass a budget. On Friday, Macron reappointed Prime Minister Sébastien Lecornu just days after he had resigned. Macron's weakened majority and a widening budget gap are fueling investor concerns, with French bond spreads now at multi-year highs. And still to come on the show, Tata Capital set to make its trading debut in Mumbai, with LG Electronics next cap off the rank. More on this multi-billion-dollar test of India's IPO markets coming up. Keep it here with us. This is Bloomberg. It is a big week for India's IPO market, with a pair of billion-dollar listings coming up. Tata Capital is set to debut today after raising $1.7 billion in the country's largest IPO this year. That will be followed by Tuesday by another mega listing from LG Electronics India. For more, let's bring in Chiranjeevi Chakraborty, who leads our equities coverage here in Asia. So much excitement and, of course, good appetite expected.
Yeah, a lot of excitement. This is a big week for India's IPO market and IPO history. We're getting the biggest listing since Hyundai's India unit got listed last year, which was a $3.3 billion IPO. And now Tata Capital, which is about to list in another half an hour, 45 minutes, is a $1.7 billion IPO and the biggest so far this year. That said, Has, at this point of time, it doesn't look like the listing pop is going to be there, given that grey markets are indicating a rather muted sort of opening for the stock.
For the longer term, this stock seems to have potential to go higher, right? There is a lot of growth story attached to it.
Yeah, that is the view that analysts are sharing at this point of time. They are more focused on the long-term potential for a sort of shadow lender in India in a developing economy. As you know, financials and lenders tend to do quite well. And that is where most of the analysts are focusing on rather than the short-term gains, given the fact that in the short term, the shadow lending industry in India is going through a bit of a margin compression. There are concerns about credit growth in the country, given the broader economic slowdown, and also about margins.
CJ, we know that India is fast becoming a fundraising hub. We've seen a lot of IPOs, big IPOs. On top of that, I think it comes down to how deep that domestic market is, that liquidity in India, isn't it?
Yeah, it's all about the domestic investors right now, and particularly the domestic mutual funds as well as retail investors who are investing into this market through these mutual funds. And they are flush with cash at this point of time. They're dominating, if you look at the anchor books that happened prior to the IPO going public, those lists are being dominated by local mutual funds and insurance companies rather than global investors, the marquee investors that we have gotten so used to dominating those lists. And clearly, they are the one who are driving, the demand for this, and also giving a lot of companies the hope that if they were to come to the market, their IPOs will successfully sail through, as we have seen throughout this year after the early, rough patch earlier this year when the secondary market itself was not doing that well.
And CJ, of course, all eyes on LG Electronics India as well, making its debut this week, in fact, tomorrow. And some say that, when you take a look at its IPO pricing, it is actually at 40% discount to its peers.
Yeah, that is true. And the funny bit is that it's actually probably become when it lists the largest listed white good maker in India, and that is where a lot of analysts are focusing at, that the valuations are quite attractive for that IPO, and we have seen that in the demand that came through from wealthy investors and retail investors when the IPO was open for public subscription. And if you look at the grey market premiums for the listing tomorrow, it is indicating a very healthy pop when the debut happens tomorrow morning.
CJ, thank you so much for that. All eyes on the Indian market as always. CJ Chakraborty, who leads the equities coverage in Asia. Well, let's do a check on markets. The Hang Seng in particular, the markets in Hong Kong, obviously getting a lot of pressure on the back of tit-for-tat development over the weekend over that trade war between the US and China. The Hang Seng currently down about 3.5%. We've seen HS Tech under some pressure as well, currently down 4.5%. It is its sixth day in a row of that drop, biggest move since April. Taking a look where we are in terms of the property index, unscathed as well, lower by about 1.5%. The big tech names are under a lot of pressure. Alibaba, case in point, currently dropping about 5%. This is one stock which has climbed about 100%, with Tencent also rising 60% in the same period. Both stocks are leading the index lower as we speak. HS Tech is standing its losses amid those US-China tensions. And we're keeping an eye on the FX space. Let's take a look at where we are in terms of where Asian currencies are doing right now. Remember that we just had optimism from the second finance minister of Malaysia saying that he expects the Malaysian currency to rise. In terms of the Japanese yen, it is down about 0.5%. The Korean won also under pressure on the back of the dollar index remaining steady at 12.12 right now. And cryptocurrencies, of course, we saw that massive move over the weekend. Bitcoin currently down about 0.1%. Before we go, here's a look at tomorrow's show. We'll get fresh market insights from Moneta senior advisor Evan David. That's as traders continue to watch the US and China trade spat, as well as President Trump's Israel visit. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.